10% of a system is not supposed to break an empire. Yet that is exactly what is happening. The United Arab Emirates, a nation holding just over 1/10 of OPEC's total oil output, has just detonated a pressure point that almost no one thought would snap first. The numbers do not add up if you are reading them the way analysts have for 50 years. OPEC, the world's most successful oil cartel, endures on the logic that individual members can always secure more profit by acting together than alone. The system is designed to suppress the very instinct that the UAE just followed, the temptation to pump, cash out, and walk away. And yet, that is the move. May 1st, the date now circled by every oil trader on the planet, is not just a new chapter. It is the beginning of a test that OPEC's founders spent decades trying to prevent. If you have ever trusted the idea that global energy is steered by a stable, disciplined cartel, you are about to watch that belief get rewritten in real time. The most surprising part is not that a member left. It is what the exit reveals about the logic that has held the system together and why that logic now looks broken. If you find yourself questioning the version of the story you have been told before, you are not alone, and I want to hear your take in the comments. And if this kind of analysis is what you are looking for, make sure you are following along so you do not miss what comes next. The dominant explanation in news headlines is simple. The UAE has officially left OPEC and OPEC Plus effective May 1st, citing a shift in their long-term strategic and economic vision. Their statement reads like the language of boardroom diplomacy: accelerated domestic energy investment, a commitment to market stability, a measured approach to increasing production. On the surface, it looks like a calculated economic pivot, a nation adjusting its policy in the face of evolving energy needs and global demand. But that is not how the oil market reacted. Prices lurched. Analysts at 3 of the 5 largest banks covering energy called it a holy moment, the kind you remember because it makes every previous assumption look shaky. The UAE, responsible for roughly 10 to 13% of OPEC's output, is one of the cartel's rare members with meaningful spare capacity. That means, at a moment's notice, they can open the taps wider than almost anyone else. In the sanitized words of their statement, they promise to act responsibly, to supply more oil in line with market needs. But behind those words is a reality. They are preparing to flood the market and collect every dollar, every euro, every yuan they can while the window is open. Most people will stop here, assuming the UAE is simply maximizing its profit, acting out of short-term self-interest. That is the mistake. The deeper logic behind the exit is not about a single country's ambition. It is about a system under strain, a cartel that has lost the gravity to hold its members in orbit. And the more you examine how this decision happened, the harder it becomes to take the official narrative at face value. Why did the UAE, a founding member and one of OPEC's steadiest players for over 50 years, decide to rupture the alliance now? The assumption is that they are angry over production quotas, blocked from exporting more, their frustration with Saudi-led decisions boiling over. That is true, but it is not the full story. To see the real mechanism, you have to look at the chain of pressures that converged on this decision. First, financial strain. The UAE's economy, once riding high on Dubai's global branding and a steady pipeline of oil profits, is now exposed in ways that few predicted. The war in the Middle East, disruptions in the Strait of Hormuz, and the long shadow of sanctions have hammered their diversification plans. In private, Emirati officials have been seeking a currency swap line with the United States, a financial lifeline that signals not just stress, but desperation. If that line is not extended, the UAE may be forced to dump U.S. assets to cover their liabilities. That is not just a local crisis. With billions held in U.S. stocks, real estate, and treasuries, any large-scale sell-off could shake American markets. Second, strategic exposure. The UAE's decision to bet heavily on the anti-Iran coalition, hosting IDF soldiers, deploying Iron Dome systems, and standing as one of the most visible U.S. allies in the Gulf, has made it a lightning rod for regional retaliation. When the war did not tilt as expected, the cost became obvious. Dubai's reputation as a safe, neutral business hub took a hit that may prove impossible to fully repair. The calculus shifted. The best way to restore financial normalcy is to reopen the oil spigot, even if it means breaking cartel discipline. Third, systemic fracture. Cartels are only stable when every member believes that the long-term payout from cooperation exceeds the short-term gain from cheating. The moment one player decides that the immediate need outweighs the future promise, the logic unravels. The UAE's move is a signal to every other frustrated member. If you are under pressure, the rules do not protect you. They bind you, and when your partners, Saudi Arabia in particular, have export pipelines and fallback options you lack, the temptation to defect becomes overwhelming. And the deeper you go into how this actually works, the harder it becomes to look at the surface version and take it seriously. Let me show you how the structure bends. OPEC's power has always rested on 2 levers: production quotas and the ability to coordinate cuts or surges in supply to stabilize prices. For most of its history, Saudi Arabia has played the role of swing producer, absorbing shocks and enforcing compliance. But cracks have been forming for years. The UAE has been chafing under quotas that froze its output at levels set before its massive investments in new capacity. Every year, the gap between what it could sell and what it was allowed to sell widened. Publicly, the UAE lobbied for a higher quota, arguing that its billions poured into expanding production deserved a reward. Privately, frustration grew. Meanwhile, the global environment shifted. The onset of the largest energy crisis in a generation, triggered by war, embargoes, and supply chain disruption, pushed every OPEC member to reassess its risk tolerance. For some, like Saudi Arabia, the pain was buffered by pipelines running to the Red Sea. For the UAE, with its exports bottlenecked and regional volatility rising, the pain was acute. Add to that the pressure from Washington. U.S. officials, fearing a spike in oil prices and the knock-on effects on inflation and political stability, quietly signaled support for any move that would bring more barrels to market. Seen through this lens, the UAE's exit was not a rogue move. It was a release valve for a system at its breaking point, and the signals were there. In the months leading up to the announcement, analysts noticed subtle shifts. Emirates officials making fewer appearances at OPEC meetings, public statements emphasizing national interest above group loyalty, quiet conversations about alternative futures. But the final blow came without warning. The initial report is that the UAE did not even call Saudi Arabia or the other OPEC powers before making the announcement. That is not just protocol broken, it is trust burned. For a club built on consensus, the manner of departure is as destabilizing as the fact itself. The escalation is visible in every direction. Oil markets have already priced in the risk of a production surge. The potential for a price war, each former ally racing to undercut the other, looms over every barrel. The knock-on effects ripple outward. If the UAE floods the market, prices drop. That pressures other members, especially those whose budgets depend on higher prices, to break ranks as well. The cartel's ability to enforce discipline erodes, and the logic of collective action collapses. But the stakes are not limited to OPEC. The impact on global financial markets is immediate. If the UAE is forced to liquidate U.S. assets to shore up its finances, the tremor runs straight to Wall Street. The U.S., desperate to keep inflation in check and its own market stable, faces a dilemma: backstop the Emirates and risk encouraging further defection, or hold the line and watch a major ally destabilize the system. The role of the U.S. dollar as the world's reserve currency, the petrodollar system, is suddenly in play. If the architecture that tied oil exports to dollar settlements begins to crack, the result is not just a spike in volatility. It is a shift in the foundations of global economic power. At the same time, Iran is watching. With the UAE out of OPEC, Tehran's influence over regional oil flows, especially through the Strait of Hormuz, becomes more visible, more direct, and more difficult to counterbalance. The possibility of Iran charging tolls for passage, exerting leverage over every tanker that enters or exits the Gulf, is no longer a hypothetical. It is a scenario now discussed in serious terms by analysts and policymakers alike. And then there is the open loop. How will Saudi Arabia respond? For decades, Riyadh has managed challenges to its leadership within OPEC through a mix of incentives, pressure, and quiet diplomacy. But this is a rupture on a different scale. If Riyadh retaliates by slashing prices, ramping up its own production, or leveraging its influence over other Gulf states, the spiral accelerates. If it does nothing, the precedent stands. OPEC members are free to prioritize national interest over group discipline. Either way, the balance of power in the world's most important energy bloc tilts, perhaps permanently. The immediate market reaction is only the first domino. The deeper risk is systemic. Cartels survive on trust, on the belief that defection is too costly to contemplate. The UAE has just shown that, under enough pressure, that cost is a price worth paying. Once the first domino falls, others reassess their own positions. Qatar, Kuwait, Nigeria all have reasons to chafe under current arrangements. The illusion of unity is harder to sustain. Most people reading headlines will see a single country leaving an organization. What they are missing is the invisible chain reaction that comes next. Here is where it gets interesting. The key insight is not just that the UAE left OPEC, but why they did so now. The decision was forced by a confluence of pressures: financial strain, strategic exposure, the narrowing logic of cartel survival, and silent encouragement from outside powers. The UAE did not just defect, they revealed that the logic holding OPEC together no longer works when the world is in crisis. When the promise of long-term collective gain is outweighed by the need for immediate survival, the system does not gradually bend. It snaps. That realization changes everything about how you read what happens next and what has already happened without anyone calling it by its real name. What does the world look like after May 1st? There are several plausible pathways, none of them stable. If the UAE follows through and ramps up production, oil prices could temporarily drop, forcing other OPEC members to decide, stay loyal or pump for themselves. If enough follow, the cartel's market power shrinks, perhaps irreversibly. Alternatively, Saudi Arabia could attempt to discipline the market, cutting its own output to stabilize prices or seeking new partners to reconstitute a slimmer, more loyal bloc. But that playbook only works if other members believe the incentives still matter. Another outcome is geopolitical. If the U.S. provides the UAE with the financial backstop it seeks, the alliance between Washington and Abu Dhabi deepens, but at the cost of further fragmenting OPEC. Meanwhile, Iran and its allies may exploit the turmoil to increase their leverage over regional flows. The real wildcard is how quickly trust can be rebuilt, or if it can be rebuilt at all. The open thread from earlier, the question of whether Saudi Arabia will retaliate or attempt to mend fences, will determine the shape of the market for years, not months. In each scenario, the common element is uncertainty. The world's largest energy system has lost its organizing principle. For From this point forward, every participant is recalculating what loyalty, profit, and survival actually mean when the rules are no longer fixed. What does this story really show? Not just that OPEC lost a member, but that the logic of collective action is always more fragile than it appears. Systems that seem unbreakable are often held together by invisible bargains, none more important than the belief that tomorrow will look like yesterday. When that belief is gone, even a 10% defection can shatter the whole design. The part that stays with me is not the outcome. It is the moment when the people who understood exactly what was happening chose to say nothing. Where do you think that line is? Leave your answer in the comments. Because the real story is not about a single country or a single market. It is about how systems break and how the world changes when the old rules no longer work. The next time you hear that a cartel, an alliance, or an empire is unbreakable, remember how quickly that certainty vanished. The future is already arriving, and it is moving faster than anyone expected. Char count 15864.